Picture this. You graduate college, you do everything right, you get the job, you save aggressively for 5 years, skipping vacations, driving a car held together by optimism and duct tape. You put away every spare dollar. And one morning you wake up, open Zillow, and realize the down payment you saved for is now worth less than half of what you actually need. You didn't get poorer. The math just changed without telling you. That's not a personal failure. That's not a generational attitude problem. That's not because you bought too many lattes. That is a broken system doing exactly what broken systems do. It keeps breaking, slowly then suddenly for the people at the bottom, while rewarding the people who are already in. And here's what's really unsettling. Nobody planned this. There's no villain sitting in a boardroom laughing. It happened because of a long series of decisions made by banks, by governments, by investors, and by basic economics that compounded quietly over 3 decades until the average American family found themselves priced out of the most fundamental idea in the American story: owning where you live. This is how it happened, and more importantly, this is why it isn't going back. Let's start with a number. In 1980, the median home price in the United States was around $47,000. The median household income that same year was about $21,000. That means a house cost roughly 2.25 times what a family earned in a year. Uncomfortable, sure, but manageable with discipline and a decent mortgage. Fast forward to right now. The median home price in America as of early 2025 is sitting somewhere around $420,000. The median household income is roughly $80,000. That means homes now cost more than 5 times the average annual income, more than double the ratio from a generation ago. And before you say, but interest rates, but inflation, we'll get there. Those things matter, but they don't erase that ratio. If anything, they make it worse. And that gap, that yawning distance between what people earn and what shelter costs, is the central wound in the American economic story right now. So how did we get here? You can't understand the crisis without going back about 30 years, because this didn't happen overnight. It happened in layers.
Layer 1. The construction drought. After the 2008 housing crash, builders got burned badly. Entire companies went under. Developers who had overextended on speculative suburban sprawl were left holding properties worth a fraction of what they borrowed to build. Thousands of construction workers left the industry and never came back. And what happened after that? Builders became conservative, traumatized, really. They stopped building at the pace America needed. For the better part of a decade, new housing starts, that's the industry term for how many new homes break ground each year, lagged dramatically behind what a growing country requires. Economists generally estimate that the United States needs to build somewhere between 1.2 and 1.5 million new units per year just to keep up with population growth and natural housing turnover. During the worst years of the post-2008 hangover, we were building around 500,000. We dug a hole, a deep one, and we never fully climbed out. By the time the economy recovered and demand came roaring back, there simply weren't enough homes. Not in the cities, not in the suburbs, not really anywhere that people actually want to live near jobs and schools and some semblance of a life. Supply went down, demand went up, prices followed. That's not complicated. That's just physics applied to economics.
But here's where it gets more interesting and more uncomfortable. The supply problem didn't exist in a vacuum. There was a quiet force sitting on top of the market, squeezing things tighter from a completely different direction. And that force has a boring name that most people have never thought about for more than 3 seconds: zoning laws. Stick with me, because this is genuinely important. In most American cities and suburbs, large swaths of residential land are zoned exclusively for single-family homes. One house, one lot, period. You cannot legally build a duplex. You cannot build a small apartment building. You cannot build anything that would house more than one family on a single piece of property in those zones, regardless of what the market needs. This seems like a minor policy detail. It is not.
What it means in practice is that the most valuable land in America, land near cities, near transit, near jobs, is legally locked into a low-density configuration that can never house enough people. A city can have enormous demand for housing, watch prices climb year after year, and be structurally unable to respond because the rules prevent the supply from growing. Houston is the one major American city with essentially no zoning, and it's one of the more affordable major metros in the country, despite massive population growth. That's not a coincidence. That's the policy working, or in Houston's case, the absence of the policy working. But most of America didn't take that road. Most American suburbs and cities spent decades using zoning as a tool, sometimes deliberately, sometimes reflexively, to keep density low, to protect existing homeowners' property values, and to limit who could afford to move in. The result is a market that physically cannot respond to demand, and a market that cannot respond to demand only does one thing with prices.
Now, layer in interest rates. And this is where the story in the last 3 years gets especially brutal. For about a decade, from roughly 2012 to 2022, mortgage rates in America sat at historic lows. We're talking 3%, sometimes lower. The Federal Reserve, in the aftermath of the financial crisis and then the pandemic, flooded the system with cheap money to keep the economy moving. And what did cheap money do to housing? It acted like a turbocharger on a market that was already short on supply. When borrowing money is cheap, people can afford to bid more for the same house. A family that could handle a $2,000 monthly payment could suddenly buy a much more expensive home at 3% interest than they could at 6%. Every buyer's purchasing power inflated, and sellers knew it. Between 2020 and 2022, American home prices increased by more than 40% in many markets. Not over a decade, in 2 years. Pandemic migration patterns accelerated it further. Remote work meant people could suddenly leave expensive cities for cheaper metros, and they did, in waves, bringing their big city purchasing power with them and blowing up prices in places like Boise, Idaho, and Austin, Texas, that had no idea what hit them. Then the Fed hit the brakes. Inflation came. The Fed raised rates faster than it had in decades. Mortgage rates went from around 3% to over 7% in roughly 18 months. And here's the cruel irony nobody warned people about. Higher rates were supposed to cool the housing market, and in a normal market they would. Higher rates mean buyers can afford less, demand falls, prices correct. That didn't happen this time.
This is the part where the math stops making sense if you look at it with normal eyes. So let's really look at it. When rates went up, existing homeowners who had locked in 3% mortgages made a perfectly rational decision. They didn't sell. Why would you sell your house, give up your 3% mortgage, and then go try to buy something else at 7%? You'd be insane to do that. Your monthly payment would nearly double for the same loan amount. So sellers disappeared from the market. The people who owned homes sat on them. Inventory, meaning the number of homes actually available to buy, collapsed to some of the lowest levels in decades. You now had a market with almost no supply because builders never fully recovered, almost no inventory because existing owners were locked in by their low rates, and demand that didn't disappear just because rates went up. People still needed places to live. Young families still needed to buy. People moved for jobs. Life kept happening. And prices, instead of falling, stayed stubbornly high. In many markets, they kept climbing because the buyers who were still in the market were competing for an even smaller pool of available homes. The medicine didn't cure the disease, it just made the patient sicker. Now let's talk about the investor layer, because it would be incomplete not to. Over the past 15 years, institutional investors, large hedge funds, private equity firms, real estate investment trusts, began buying single-family homes in significant numbers. Not as many as the internet tends to claim, the narrative can get hyperbolic, but enough to matter in specific markets. Invitation Homes, one of the largest single-family rental companies in the country, owns over 80,000 homes. BlackRock-backed funds have been active in residential markets.
Countless smaller investment groups, enabled by cheap debt and sophisticated data tools, have quietly assembled portfolios of rental homes in the same neighborhoods where first-time buyers are trying to compete. When an investor buys a home, it comes off the for-sale market permanently, or at least until the economics of owning it change. It becomes a rental. The family that might have bought it gets a landlord instead. The investor doesn't need the home to be cheap, they need it to generate yield, and rent yield works just fine at high prices. Is institutional buying the primary driver of unaffordability? Probably not. The structural issues, zoning, underbuilding, rate dynamics are larger forces. But investors add pressure on top of an already tight market, and in specific zip codes and price ranges, their presence has been documented to move prices measurably. The deeper problem is what it signals. When housing becomes an asset class, it stops being optimized for shelter. It gets optimized for return. And return doesn't care whether a 32-year-old school teacher can afford a 2-bedroom in Phoenix.
Let's put the math on the table for a minute, because numbers have a way of cutting through the noise. At a 3% mortgage, a $400,000 home with 20% down, so an $80,000 down payment, already a serious ask, carries a monthly payment of roughly $1,350 on the principal and interest alone. Add taxes and insurance, and you're maybe at $1,800 a month. It's 7%. Same house, same down payment. Your monthly payment jumps to about $2,130 on principal and interest. With taxes and insurance, you're looking at closer to $2,600 a month. That's not a rounding error. That's $800 more every single month, nearly $10,000 more per year on a house that hasn't gotten any bigger or any better. And now consider that the down payment itself is the other mountain to climb. 20% of a $420,000 median home is $84,000. The median American household saves somewhere around 4 to 6% of their income in a good year. On an $80,000 income, that's maybe $4,000 a year in savings, assuming nothing unexpected happens. No medical bills, no car repairs, no layoff. At that rate, saving a full 20% down payment takes over 20 years. 20 years, and prices will have moved by then. This is not a math problem that discipline and hard work can solve. It is a structural problem dressed up as a personal failure. Here's where the story gets its sharpest edge. The people who already own homes have watched their net worth balloon. The median homeowner in America has seen their home equity increase by hundreds of thousands of dollars over the last decade, not because they did anything particularly clever, but because they happened to buy before the system closed. They are, through no special genius, dramatically wealthier on paper than they were 10 years ago. And the people who couldn't buy, who were too young, who were paying student loans, who were in cities where even a starter home costs $700,000, who were working-class families who never had an $80,000 down payment lying around, those people watched from the outside as the window shut. The home ownership rate in the United States has actually held relatively steady, hovering around 65 to 66% over the last decade. But underneath that number is a significant demographic skew. Among Americans under 35, home ownership rates have fallen substantially compared to previous generations at the same age. The wealth that housing represents is concentrating among older Americans who already own, and it is increasingly inaccessible to younger ones who don't. This is, quietly, one of the most significant wealth transfer mechanisms in modern American economic history, and most people haven't framed it in quite those terms yet. Let's zoom out for a second, because this is about more than just houses. When people can't afford to buy homes, they rent. When more people rent, demand for rental units goes up. When rent demand goes up, rents go up. The average American renter is now spending more than 30% of their income on rent. That's the threshold economists traditionally define as being cost-burdened.
In major coastal cities, the figure is dramatically higher. In Los Angeles, in New York, in Miami, in Seattle, many renters are spending 40, 50, even 60% of their take-home pay just on shelter. When half your income goes to the landlord, you can't save, you can't invest, you can't build anything resembling financial resilience. You live paycheck to paycheck, not because you're irresponsible, because the structural cost of existing in a functional city has crowded out everything else. And here's the downstream consequence that doesn't get discussed enough. Labor mobility collapses. One of the things that made the American economy so dynamic historically was the ability of workers to move to where opportunities were. You could pick up, go where the jobs are, and build a life. That calculus breaks when a move means surrendering an affordable lease and stepping into a market where a two-bedroom apartment costs $3,500 a month. People stay put, not because they want to, because moving has become financially catastrophic. And an economy where workers can't move to opportunity is a less productive, less dynamic economy for everyone. There's a political dimension here too, and it's worth naming plainly, without pretending it belongs to one side or the other. Every attempt to meaningfully increase housing supply runs into the same wall. Existing homeowners, who vote at much higher rates than renters, have a direct financial interest in keeping supply constrained. Their home is their primary asset. They don't want more supply. More supply means more competition. More competition means potentially that their home stops appreciating so fast. This creates a structural political problem. The people who benefit most from housing scarcity, existing owners, are the most politically active constituency on housing issues. The people who suffer most from it, renters and aspiring buyers, disproportionately younger and lower income, are less organized, less likely to show up to a zoning board meeting at 7 p.m. on a Tuesday, and often not yet rooted in the communities where those decisions get made. City councils get captured not by sinister conspiracies, but the ordinary physics of civic engagement. The neighbors who show up and say, "Don't build that apartment complex," have more political weight than the thousands of hypothetical future residents who would have moved in if it had been built, but currently don't exist as a constituency. This is the political economy of scarcity, and it is extraordinarily hard to break. Some states have tried. California passed legislation overriding local zoning in some circumstances. Oregon moved to legalize duplexes statewide. Minneapolis ended single-family-only zoning entirely. These are meaningful experiments, but they are early, partial, and fiercely contested. The inertia of the existing system is immense. There's one more force worth understanding, and it lives at the intersection of culture and economics in a way that makes it almost impossible to talk about without someone getting defensive. America has treated housing as an investment for so long that we've forgotten it was originally supposed to be a consumption good. You buy a house to live in it, to raise a family, to be stable, not to watch your net worth compound. But somewhere in the post-World War II prosperity, in the expansion of the suburbs, in the creation of the mortgage interest tax deduction, and the political sacredness of home ownership as the core of the American dream, housing got financialized at the cultural level, not just at the institutional level. Normal families started thinking of their home as their retirement account, as their primary wealth-building vehicle, as an asset first and a place to live second. And when that mental shift happens at a mass scale, the politics of housing supply become almost impossible to reform. Because now, you're not just asking a homeowner to accept a new apartment building down the street. You're asking them to potentially accept that their primary retirement asset won't keep appreciating at 8% a year forever. That's not a policy conversation. That's a threat to someone's financial survival. And people respond to threats to their financial survival with significant political ferocity. This is the trap. The very thing that made home ownership so appealing, that it built wealth, has made the system almost impossible to fix, because fixing it, in the honest sense of making housing affordable, means making it less valuable as an investment for people who already own. And in a country where 65% of households are homeowners, that's not a winning political platform. So where does this leave us? There's a version of this story that ends with a solution, a tidy prescription. Build more homes, reform zoning, regulate institutional investors, and watch the market correct. And those things are genuinely useful. The research is relatively clear that cities and states that have allowed more supply have fared better on affordability over time. The economics are not mysterious. But the timeline is the problem. Even if the political will materialized tomorrow, which it hasn't, building enough homes to close a multi-decade supply gap takes years. Construction has physical limitations. Labor has to be trained and recruited. Permits have to be issued. Infrastructure has to be built. You cannot solve a 30-year underbuilding problem in 3 years. In the meantime, a generation of Americans is either being priced out of ownership permanently or is stretching so far to get in that they're one job loss or medical crisis away from catastrophe. They're buying homes they can barely afford at prices they know are historically anomalous, at interest rates that would have seemed punishing to their parents, because the alternative, continuing to rent with no equity, no stability, no escape from landlord whims, feels worse. That's not a housing market. That's a trap with a welcome mat.